Good morning, everyone, and welcome to our very first webinar. We will be putting all this information on the website, but you are about to have the most extraordinary experience as Mike Sibley teaches you and trains you on all the wonderful tax exemptions that are available to us. This webinar is how to navigate the complexities and reap the benefits of manufacturing and tax credits and deductions. We'll be discussing a wide variety of tax credits and deductions available to our manufacturing companies, and they are complex, but this will be posted on the website. We'll have documents for you to take a look at, and then of course you always have access to Mike, who can explain it to you. This is Jane Pfeiffer, the President and CEO of VMA, but I think I know everybody that's out there. Let me talk about a couple of really great things that are going to be happening in the fall as we start our very busy season. First of all, this is not the fall, this is in August. We're going to have our Brewing New Ideas on August 18th at the Tomoka Brewery in Port Orange. You'll want to come out and connect with your fellow VMA members. It's a lot of fun. And we do give a free beer if you give us 3 good suggestions, because we want your VMA to be your VMA. We are also starting the work and getting sponsors and people engaged and involved with our Manufacturer Showcase, which this year is on September 30th at the Ocean Center. That event kicks off our Manufacturing Month. This year we will also do the Manufacturing Champions School Counselor Bus Tour. That's going to be October 21st. And we are going to begin seeking nominations for Manufacturer of the Year. So that's enough information from me, because Mike, as I said, is going to give you some very good information. Let me tell you that if you are looking for CPE credit, we'll be sending you an email in the next several days that include copies of the slides. Or you're going to be able to go to the website and get everything you need in order to get your CPEs. And now I have the great pleasure to introduce Mike Sibley. He is a CPA and partner with James Moore & Company and has nearly 20 years experience serving the manufacturing industry. He's a longtime member of VMA and serves on our board of directors. He's the head of the Finance and Accounting Division, and that's why we're having this webinar. Mike provides services such as research and development credits, interest charge, domestic international sales, corporation. I'm reading this, so I didn't do that so smoothly, sorry. He's also a certified black belt in Lean Six Sigma. He has led or been involved with numerous Lean projects with manufacturers, construction companies, business service firms, governmental and higher education organizations. And so, let me turn this over to Mike Sibley.
Good morning. Thank you, Jane, for that introduction. We're really excited. Jane and I have been very, very excited to be here doing a webinar. We've been talking about doing a webinar through the VMA for several years now, and finally we're getting to that point where we're actually doing one. So we've both been very excited this week, and as we were going through the setup of this, and so really at the end we're going to ask for feedback from you on how this went, how we did with it. Also, and probably most importantly, what kind of information do you want to learn about in the future? What other topics can we cover? That's one of the most difficult things we're trying to get information on, so that way we can provide relevant seminars, whether they're live or whether they're through webinar. And that would be the other thing I'd like to know. Is this format better for you? Or do you like a mix of live formats and webinar formats? Really just want to try to make it as meaningful as possible for you guys, and what would be the easiest way to attend these things. So look forward to that feedback at the end. If you guys could all please respond to that. We're going to do several, 3 polling questions throughout the presentation. That's part of the requirements in order to have CPE, but also it helps give us some information. So before we actually get started into the presentation, we're going to do our first polling question, and you're going to see a poll pop up. It's going to ask, have you attended any of the VMA's Brewing New Ideas events? And I'm just going to give you 10, 20 seconds to answer this, and then we'll talk about what we see. All right, so it looks like.
Okay, so you'll need to come out on August 18th and see what it is. It's a fun event.
Yeah, so it looks like most have not been able to attend yet, and like Jane said, there's one coming up in August, I think August 18th. These are really fun events. They're a lot different than the events that we've had in the past with the networking and then sit down for dinner and a speaker. This is a great networking opportunity and get to know other members and network. So really, really encourage you guys to come out and experience some of this. It's been a real lot of fun. All right, so getting into the meat of the program now, I'm going to focus on just a few areas today. We've kept this relatively short for our first webinar, but I want to focus on some of the key things that will really impact manufacturers, specific to manufacturers. These are key areas that I tend to see weaknesses, perhaps, in what manufacturers are actually achieving for deductions. They're not getting everything that they possibly can, or they're not even taking advantage of it at all. So these were the key areas. Also, when we did poll some of our members, some of the specific questions they had were about what is required for documentation. So I'm going to hit a few of the areas that are probably most important from a manufacturing standpoint, and secondly, cover some of the documentation pieces that you guys would need to consider in order to make sure that you're, I don't want to say fireproof, but try to give yourself the best protection if you ever had to deal with the IRS on those matters. And I'm going to start with the PATH Act that was passed in December of 2015, because this really pushes into some of those credits and deductions that we're talking about because of the provisions that were passed. And like I said, it was passed in December and it was retroactive to 2015, but it really either reinstated or made permanent a number of deductions. So hitting on some of those, the top level ones, first of all was Section 179 in bonus depreciation, and I'm sure you're all well aware of these. These have been around for a long time. What really happened here is they made the Section 179 $500,000 deduction, up to $500,000 deduction, permanent. They also made bonus depreciation, extended it through 2019, and with a sliding scale down. Why are these important? Well, it gives us certainty from a planning perspective. And this last year, we had no laws passed yet up until December, and so when we were talking to our clients about planning, we said, well, if they pass this, this is what we think you can save from a tax standpoint, or if they don't, so we ended up running two different scenarios depending on what we thought Congress might do or might not do. And so what this really does is gives us a lot of certainty, allows you as manufacturers to plan ahead and plan ahead years. So for example, your CapEx budgets, as you start planning ahead, you can take that into consideration in terms of your budgeting, your planning, what your CapEx needs are going to be, and then ultimately your potential tax that comes along with that. Also, as part of the law, they made permanent a 15-year depreciation for certain real property improvements. So the key thing here is planning ahead, understanding what's available to you, and also making sure that when you start talking about getting these items placed in service, that becomes the key date in terms of deductions. Now, I'm going to talk about today two of the big things is research and development tax credits and work opportunity tax credits. R&D has been around for decades, but it was always renewed annually for the most part, or maybe every couple of years. It was never made permanent. And so what this law did was make the R&D credit permanent. Not that I think anybody ever really doubted that they were going to get rid of it. There was never really any doubt about that. But again, this placed certainty in the tax law. So that way it's something that you can plan for and not worry about. You never know. A certain administration and certain Congress could get in there and decide to wipe certain things out. You just never know. But this put that certainty in there for us. Also, for corporations, C corporations that convert from a C corp to an S corporation, they reduce the amount of years that you would have to recognize a gain if you were to sell it. It used to be that if you switch from a C to an S, you would have to wait 10 years before you sold it, Otherwise, you'd have to pay what's called a built-in gains tax. They reduced that down to 5 years, and in fact, we already have some clients that are able to take advantage of that because of this rule. So it's a really good. It gives you an opportunity to reduce that time frame. The work opportunity tax credit, we're going to talk about that in a little bit more detail, but essentially what they did was they added more categories to the people who are eligible for the credit, and then they extended it through 2020. And then, of course, there's a number of other favored positions, but I wanted to just hit the ones that are real relevant to this conversation today. Another really good provision was they put in a $2,500 safe harbor for deductions. So, in other words, if you have a policy in place for capital additions that says, I'm going to expense everything under $2,500, then you can set your threshold at $2,500, which is a great thing, because in the past, people would use $500 or $1,000. Well, the reason this is great is because you can expense those items immediately and not use up any of your 179 or any of your bonus depreciation, because those have, well, 179 has limits. And so once you get over that limit, then you're stuck into depreciation. So this is a really good thing because it allows you to just deduct. The other thing is it's just a safe harbor. If you deduct it, you don't have to worry about the IRS coming in and challenging your capitalization threshold. So the key thing is having an accounting policy in place as of the beginning of the year. So make sure you guys have those accounting policies in place and set it at the $2,500 if that makes sense for you as a safe harbor. And of course, that applies to what you do on your book purposes and what you do on your tax purposes. Now, some of you out there may have audited financial statements, and there's actually a safe harbor for companies who get audits to have up to a $5,000 safe harbor. So a number of rules here, but this was a really good one. It takes out some of the, again, some of the uncertainty and the judgment of saying, okay, well, what should my threshold be? What's appropriate for my size business? It just takes all those questions away, makes it be a safe harbor that you can easily set up a policy for, and really, I think, makes tracking that much easier. That said, you do still have to be careful, because Volusia County, for example, has a tangible property tax. They do not have a safe harbor like this. So, for example, if you buy a computer for $1,000, under this rule, you can expense it. Under Volusia County's tangible property rules, you still have to track it for the tangible property tax return. So there is a tracking mechanism there that still needs to be in place. Now, the county could always come in and audit your tangible property tax, and so that's just something that you have to think about. Very possible to do. It's not too difficult, but it's just an extra layer of administration if you want to take on this type of safe harbor. All right, we're going to come up with our next polling question, and it's, have you taken advantage of the R&D credit? I'll give you a few seconds to answer that. Great. That's, yeah, 88% taking advantage of it in some way, shape, or form. So a lot of this will be familiar to you then, but hopefully we'll be able to cover a few things that will possibly allow you to take more advantage of it. Maybe there's some areas that you didn't realize that it applied to. Perhaps you're not comfortable with the documentation that you have, and so that we can talk about a couple of those things. But it's great to see that most people are taking advantage. For those who are not, most manufacturers have some level of research and development or research and experimentation that they're usually undertaking. So there may be some opportunities here. No matter how small or large you are, if you're not taking advantage of it, there may be some opportunities for you. And the purpose was to encourage new research and development. And the IRS is constantly looking at this and refining it. They've really focused a lot of efforts in their enforcement initiatives to make sure that companies that are supposed to be taking it are taking it. There's been a number of companies out there that were just trying. There's a number of companies out there that sell these services to do the R&D tax credit for you, and they calculate it. And they were super aggressive. They were putting things in there that just never applied, and the IRS was all over this stuff. And they were taking a very aggressive approach to their interpretation of it. So they've had some enforcement over, but the reality is for manufacturers who are building new products, new processes, testing new things, that's all available for you. So you should take advantage of it. You shouldn't worry about the IRS as long as you do some of the things that we talked about today. There's been over $6 billion in subsidies for companies, so this is a huge opportunity out there. And it's really for designing, developing, improving products, processes, techniques, formulas, software even. There's several different methods for calculating it, so that's something you'll just want to talk to your accountant about. At the end of the day, you can probably get a tax credit. I'll just give you an approximate, about 6% of whatever that R&D number you come up with. So if you have $100,000 in R&D expenses, you could probably expect somewhere around a $6,000 tax credit. Now, that's a tax credit, which means it's not a deduction. So it's not that you're getting tax savings of $2,000. You're getting a $6,000 credit against that tax. That's why it's such a great tool for everybody to take advantage of. So as we get into specifically, the research is undertaken for a purpose of discovering. There's a discovery piece. It's research and experimentation is really what this is all about. There's a potential for failure in this project that you're undertaking. And it's got to be something that's for a permitted purpose. And we're going to talk about some of those purposes in a second here. So here's some broad activities that are generally involved. The reason I say broad is because it may not hit on every single potential that are out there. These are just kind of the typical ones you might see. So developing new products. When you're developing a new product, there's all sorts of opportunity for failure along the way until you get to that point that you know how to build it, it works exactly the way you want it to, the configuration is all done, but in between there's designing, there's testing, there's building models, there's those models that fail, and so you've got to go back to the drawing board. It's part of the cost of getting for patents and the testing, these new technologies that are out there, even environmental testing and developing software technologies. So even, and this is something that surprised me years ago when I learned, even streamlining some of your processes can fall under this scenario. Now, when you get into this, oftentimes the calculation of the tax credit or the accumulation of the R&D expenses are really done by the accounting group because they're accounting for the numbers. What I would encourage you, in order to maximize your benefits, would be to get engineering people involved. Maybe you have engineers on staff. Maybe you are an engineer if you're a business owner. But you really want to get that technical insight into what is happening here and how to accumulate that from a project standpoint. And I'm not suggesting that you set up project accounting systems in your general ledger or anything like that. I'm saying, offline, get with your engineers and have them help you identify the project and potential risk and all the components that go into it so you can completely track and maximize all the efforts that are going into this research and development. When there are some good firms out there, specialty firms that come in and do this work, we work with some because they have engineers on staff. That's what they do. They understand this. So that's why I make if you don't use one of those, and I know some of you out there do use those, if you don't use those, use your internal personnel to make sure that you're maximizing. So that way you can increase that potential benefit that where you are now. It's possible that there's more opportunity out there. And that's something that I often see as well when we come in and we're talking to companies is they're taking it, but they're not getting all that they could possibly get out of it. So that's why I encourage you to get your engineers involved. There's just an extreme amount of judgment, and sometimes that's an uncomfortable place to be. Some companies just tend to err on the side of caution and decide, you know what, we're not going to go there, and that becomes very much a judgment call. There's not going to be a set answer that says specifically, yes, this is it. You have to kind of make your case in the documentation that you maintain, and we'll talk about that in a little bit. You have to really make your case for what you're doing so that way you reduce your risk. All right, so what kind of costs go into the calculation for the R&E tax credit? Well, in-house wages is one of them. So you have an engineering group, perhaps, or you have employees who are building models. Okay, those wages are things you want to track. Also, the supplies and the materials that go into building these models are also applicable. And then research expenses, contract research expenses. So this is using somebody outside of your company that you're paying, some supplier vendor to do some of this research for you. You can get up to 65% of that. I skipped a bullet on the time-sharing costs for computer use. That's something you don't really usually see from most manufacturers. Just know that it's out there. The main things that you're going to see is your wages, supplies and materials related to the project itself, the process that you're looking to claim the tax credit on. And then oftentimes we see outside vendors used as well for some portion of this. You get to claim up to 65% of that. So you're going to aggregate all of these different line items to be able to calculate your total research and development expenditures. Then from there is where the calculation piece comes in. That's where you talk to your accountant in terms of getting those tax credits. So substantiation is, you must have some documentation, whether it's paper or electronically. Now, if you've ever gone through one of these external companies that come in and help you calculate it, you've probably seen, hey, we don't have project accounting labor tracking, for example. In other words, we don't have a timekeeping system. Well, what the courts have said is it is completely okay to come back and rely on the testimony of the people who are participating in that process. Okay, so what that means is, even if you don't have a time tracking system by project, you can go talk to the people that are involved and get their best estimates as to what they say they spent for time, and then you can include that in the calculation. So that would be something that you can kind of do offline. I would step back with a bigger, kind of like a project charter. Think about, I'm using my Lean Six Sigma style, how we get started. We start with a project charter. What's the purpose of this? What are we trying to get out of this? You can have a document that just has the purpose of it. What are we trying to get out of this project? And then start to fill those pieces out, the technical pieces of what you're trying to do. So that's kind of your project charter. And then have an accumulation of what are the costs that are going to go into it. You may even set up kind of a budget or a thought process as to what's going to be involved, and then ultimately track those costs. So when somebody's spending time, that they're spending time because you've gone through a project management tool here. Okay, you've set resources aside, you've talked to them, get their information and track it. Put it in this spreadsheet or this document that you're preparing. When you do testing on equipment or a product, keep the results of those tests. Document the results of those tests. Show that there was failure and that it didn't meet your initial configuration requirements, and so that you had to go back and do those things. I want you to document all of those things every step of the way. Some of this may sound a little bit like overkill, but when you're dealing with trying to make sure that you're as fireproof as possible against any sort of claim from the IRS, you want to be somewhat bulletproof here and have this documentation. I think the more that you have in this particular case, the better it will be. So really, I would start with that project charter. Start with what's the purpose of it, what's the risk, what do you hope to get out of it, and then track the individual components of costs that go into it. If you have the ability in a general ledger system, that's great. If you have an ERP system with time tracking, great. That just makes it all the better. But if not, it's not a requirement. It's just a matter of having something that allows you to do that. And I forgot to mention at the beginning, if you have questions, we're going to save a few minutes at the end to go through questions. We'll go through as many as we can. We may not be able to answer all of the questions that you have. And if we can't, we'll do our best to kind of follow up after the fact. Like Jane said at the beginning, we're going to post this webinar on the VMA website after the fact so that you'll have access to it again. And then, again, you can always follow up with me individually if you have questions that you'd like to go over. Moving on to the Work Opportunity Tax Credit. As I said, the PATH Act extended it to January of 2020. Really, there's over $1 billion in tax credits claimed annually, and this is an opportunity for employers to hire certain individuals. It was really to encourage the hiring of certain individuals to help get people back to work. And the tax credits are pretty substantial, and there's really no minimum or maximum amount in terms of the number of people that you can claim this on. So if you hire 30 people that fall in the required classes, you can get the tax credit on all 30 people. So this is a tremendous opportunity to hire people in these classes, and I'll go through that in a minute. And it's a great opportunity to really take advantage of the system. So who's eligible? Well, we have veterans. We have temporary assistance for needy family recipients, SNAP recipients, designated community residents, vocational rehabilitation referrals, ex-felons, supplemental security, and summer youth. Now, there's a couple of them that say living in a empowerment zone. We have 3 in Florida empowerment zones. None of them are around here. So anything that says empowerment zone does not apply to you, probably, unless you have facilities in Jacksonville, Miami-Dade, or Southwest Florida. And even if you're in those areas, when you look at the map, they're actually little tiny parcels within those areas. So it's very, very limited. And the rural renewal counties, there's none in Florida. This was something that started quite a few number of years ago. So none of these are in Florida. So really, you're going to be looking at probably your veterans, your ex-felons, maybe some of the temporary assistance that you're getting as probably your primary sources of people that you may be able to hire in terms of eligibility. Now, the good thing is if you've hired anybody from, say, December through now and haven't claimed this credit, there's still part of what the PATH Act did was give you till September to have this opportunity to get those tax credits. Typically, it's a 28-day time frame, and after that, you don't have the ability to claim the tax credit anymore. So employees have to be certified as part of this process, and what I'm going to do is actually, I'm going to skip here and tell you, here's how you do it, step by step. First thing is you just register online at floridajobs.org. So go there. There's 2 IRS forms, 8850 and 9061. These forms are completed by the employee. So I'll step back for a second and tell you here's what we do when we're working with we have some clients, a restaurant client, for example, where we're applying for this constantly. You can imagine a big restaurant chain, they're hiring lots of employees. So we go through this process. They give their potential employee or the employee that they're going to hire these forms. We load them up online for them, and then within 24 hours we get the certification back. And so the key to doing that, though, is you've got to be registered online. Like I said, you get these forms completed, you upload them you submit them online through the Florida Jobs website, and then you receive back the certification from the state, typically within 24 hours. And then at the end of the year, you file IRS form 5884. Really fairly simple process. In terms of just get these forms completed. I think your first time or two, if you haven't done this before, your first time or two can be maybe a little bit more complex. Again, I'll just encourage you to talk to your accountant on this too, because they're going to help you. They can help you walk through this process. So it's just one of those things that the key thing to remember is this certification process at the beginning, so you can take advantage of this. And beyond this, from a documentation standpoint, this is all you need. This is really it, because you're going to get that certification back from the state that says, yeah, you're good to go. And then from there, it's just a matter of tracking all of those individuals and their wages, which you're going to do anyway through your payroll systems, and then you submit for the tax credit when you file your tax return. Now, how does this look? One step before I do that, if you ever have more questions about it, besides talking to me or anybody at my firm, you can talk to your accountant. There's also resources at the Florida Department of Economic Opportunity on this. So I've given you that contact, so that way you could always follow up if you have more questions there. So rather than go through a few slides here about how it's calculated, I want to just go, and you can read all of this stuff. You're going to have the resources, but I want to just go to this chart, because this chart basically spells it all out for you. And we actually have this in an Excel spreadsheet that allows you to change you just change the class, the A, BA, BB that you see on here, and put in the wages, and it calculates it out for you. So I took kind of our formula out and put it in here so you can see, you know, the different classes. You can see there's a max amount of wages because there's more incentive to hire certain groups of veterans, for example. So you can see that the max wages go up to $24,000 with a max credit of $9,600 for certain veterans groups. Okay, so it's a real incentive to try to employ those veteran classes and certainly give you that credit availability. And as a side note, as I'm sitting here thinking, I believe a lot of you probably already know, but there is, through our local, they used to call it Workforce, I can't remember, Career Source now, they do have training grants available as well for people that before they start with you, before you actually hire, you've got to be talking to the Career Source, and if they still have funds available, there are training grants as well. And those can be pretty substantial dollars too, compared to the salary of the person that you're hiring. And so I would encourage you to talk to the local Career Source about that program. On top of that, if you hire anybody in these categories, you can see that, you know, anywhere from a minimum of $1,500 to a max of $2,400 in some cases, or even, you know, $9,600 in the cases of certain veterans. So just going back a step, the key thing here is get them certified, get registered, get them certified, get them to fill out those forms, get that certification back, and then track their wages. And, you know, submit this stuff. Make sure you submit it to your accountant at the end of the year so you can take advantage of this tax credit. And I put in some more resources. Part of what I wanted to do with this was give you guys as much resources as you can so you can do a little bit of research on your own. Again, you can always contact me about it, or you know, talk to your accountant about those things. A little unknown, I shouldn't say unknown, but a little used possibility for a tax credit is propane. It's an alternative fuel tax credit. And so the propane that's used in forklifts, it's possible that you can get a tax credit up to 50 cents per gallon for the propane that you use in a forklift. Not everybody uses propane in forklifts. Not everybody uses propane. But if you are using propane, you can claim the credit on Form 4136. So these are the documentation pieces of it. It's something that you just need to take an assessment of and see if you're using it. You know, so there may be another opportunity to get, you know, I've seen as high as a couple $1,000s or so in credits that have been available to small businesses, small manufacturers. So it is something that's out there. And, you know, when you start adding up the R&D credit, if you've got people in the work opportunity tax credit, you've got this alternative fuels tax credit, you're starting to add up to quite a few tens of thousands of dollars of savings here. So it's just a matter of identifying and then tracking. Tracking becomes the key thing here. And so what are we talking about when we talk about tracking? Well, how much are you using? How much have you purchased? The dates of the purchases, names and addresses of suppliers. And I did a little bit looking up on this, and the recommendation was to maintain records at least 4 years after you file a claim. Generally speaking, the IRS, you always have 3 open years, so I'm not sure that any more than 3 years would be necessary, but one of the recommendations I saw here was 4 years. So I think the big thing to just ask your company is, and you may already know because you pay, you know, if you're the accountants and you're paying the bills, are you using propane? And if you're using propane, there's a potential out there for a tax benefit for you. For our smaller businesses, meaning, you know, if you're a company that's about $1 million or less, there is this thing called the Disabled Access Credit. And even though this isn't specific to manufacturing, I wanted to bring it up because it encourages businesses to make changes for giving more access to people with disabilities. and maybe you're going to do it anyway, but why not claim the credit for it? And so there is a credit out there that could be up to $5,000 per year for making these changes. And so when we start talking about what are these changes, it's for the purpose of removing architectural, physical, transportation barriers. And let me give you an example. I was working with a physical therapy clinic a number of years ago, and part of what they did, they had to do was take the counter where the patients would come up to pay their bill or to check out or check in, and they had to reduce the counter size down to a lower level because people in wheelchairs would not be able to see over the height of the counter. And so that cost, I don't know, say a couple $1,000s or so to make that change, and we were able to take the cost and then claim the credit for that. So it was because it gave people more access. And think about in your facilities, if you're making changes, you're making improvements in restrooms or in the ability to get to a certain area in your manufacturing facility so that people with disabilities have greater access, track those costs. Just realize what those costs are. And let your accountant know that, hey, do I qualify for this? Because I might be able to get some extra credit here. As opposed to what you would normally get is a depreciation deduction, and that depreciation deduction would occur over time. So you get, say, 20, 30, 40%, depending on your tax levels. This actually takes away the deduction and converts it into an actual credit. So credits are always better than deductions. That's kind of the general rule of thumb. Is you want to have credits whenever possible. And there's also another level here for deducting up to $15,000 of expenditures to remove architectural and transportation barriers. So the key thing I want you to know here is if you're making modifications to your plant, to your accessibilities, track those costs. Talk to your accountant. You may have an opportunity here. Another area I want to talk about, and this has been out for a real long time, for over 10 years now. It can be a pretty sizable deduction, but sadly I often see not enough people taking advantage of this, or I see opportunities where they're not getting a great enough advantage of it. This started back in 2005, and it used to be about 3% of net income from eligible activities. It's phased up to 9% now. So essentially, if, say, 100% of your activities are all manufacturing, so domestic production activities, you get 9% of your net income as another deduction, right? This was going back to the George Bush days from his presidency and trying to encourage more manufacturing in the United States. This does not apply to manufacturing that occurs outside of the United States. This also does not apply to if, say, part of your revenue sources are buying and then just reselling something. It does not apply to that stuff. It applies to production activities, so making something and then essentially selling it. And oftentimes, this even applies to contractors, architects, engineers can take advantage of this. So there's a broad group of people that are actually applying for DPAD. So again, it's manufacture, production, growth, or extraction. Any of those areas are considered manufacturing eligible for this. Even construction of real property. As I mentioned, engineering and architectural services. So if you fall in any of this, you need to be making sure that you've been taking advantage of this deduction over the years. The reason I say that is I have seen a number of manufacturing type entities not having this deduction on their tax return. And it's something that it's not something that is really necessarily on the forefront in the tax return. You kind of have to look for it. And especially if you're an S Corp or an LLC, you're not going to see it as a deduction on your tax return because it's a flow through to the actual business owner. And so they'll get it at their level. So it can be kind of tricky it can be kind of tricky identifying whether you're getting it or not. So this is something that I want to make sure that you're taking advantage of. What you want to do and what you're going to do is you're going to identify those areas of production. You're going to calculate it and then allocate. Now there's 4 different methods here, and this is where it can get complicated because what method is going to be working for you? If you're a small business under $5 million, you're automatically using the simplified method, which is really just a matter. It's just taking 100% of what you have or just allocating. If you're 50-50 manufacturing and 50% say distribution, it's just going to allocate everything out 50-50, and you're going to get a deduction on that. There's also a specific method, and if you're a larger company, say over 100 million in receipts, you're going to have to go to what they call a specific identification type of method, where you're specifically identifying your cost of goods sold and your production activities. Probably a lot of you fall between the 5 million and between 100 million perhaps. And there's a couple other methods in there. And what you really want to look for is what are your production activities and what are your non-production activities, because you want as much as you possibly can get into that production activities. Now, here's where sometimes it can get, you can increase your ability to get this deduction a little bit, because if less than 5% of your total revenue is non-applicable to DPGR, the domestic production gross receipts, it's a de minimis safe harbor. You can include 100% of it. So you can kind of eke your deduction up just a little bit more. Again, it's 9% of that number, so if you haven't been doing that, chances are it's probably fairly minimal. But it's something that at least you can look into. So again, what you really want to do here is make sure, 1, it's being taken advantage of. 2, you want to make sure that you understand what your production activities are, and and make sure that you're claiming everything that you're available to. And I'll give you an example of one where it's often missed. Say you produce a piece of machinery that you then lease out to somebody else. You still own that machine. That applies. That lease revenue actually applies. And so I know there's some companies out there that actually do that. They manufacture their own equipment and lease it out. Well, you want to make sure that that lease revenue is included in the DPGR, so you don't miss that potential deduction. And that's one of the areas that I see in manufacturing that's often missed the most, outside of not taking it at all. Again, from this standpoint, there's not a lot of documentation requirements. It's just a matter of being able to prove that it's revenue from items you've produced. Cost segregation studies, I just wanted to bring this up. I know there's some big projects going on in the area, and with some real estate being built over the next couple of years. And if you're building a building, and I've always heard the break even is about $1 million. You really need to look into a cost segregation study, and this is one where you pretty much have to hire an outside specialty firm that does these things, because they have engineers that analyze this. Anytime that I know that I've seen CPAs do them in the past, CPAs are not engineers typically, and they generally don't do the job that you need to have done here, because you've got to have some real expertise. What a cost segregation study is going to do is it's going to analyze the components of the construction, and they're going to allocate them out to different classes. Typically what has happened when you build a building, you accumulate all the costs into one bucket and you depreciate it over 39 years. What a cost segregation study is going to do is take those buckets, take those components and break them down into potentially 5-year depreciation, 7-year, 10-year, 15-year. It's going to spread it out over that. So that means you're going to get the deduction one way or another. What this is doing is speeding it up. And so it's a time value of money thing. So if you built a building or had an addition built of, say, $1 million or more in the last 10 years, maybe 15 years, even going backwards, there's still opportunity to take advantage of this. Certainly if you've got a good-sized project going in the future, this is something that you want to get in on the front end of it, because it actually makes it easier for those specialty firms, those engineers, to analyze the data up front. It helps them tremendously. So if this is something you're doing, really strongly consider getting a cost segregation study done. It'll certainly save you from a time value money standpoint earlier, and by having the study done, it's supportable with the IRS to take those deductions as well. I almost left this out because we've talked about it so much, but Jane was making sure that I didn't forget to talk about this, because the VMA, the Manufacturing Association of Florida, and many of our representatives, they worked really, really hard to make sure that we got this sales tax exemption on machinery and equipment. And I'm not going to read all these slides. I'm just going to talk about it for a minute. But basically, we were looking at it going away in 2017. And so this past year, they made it permanent, which is fantastic. And what really in the past, there was always a sales tax exemption on machinery and equipment, but you had to jump through some hoops. You had to show that there was growing production. There were a number of things that you had to do. So what this did really was said, hey, if you're an eligible manufacturing business, so in other words, you make something, and you're buying equipment with a life of 3 years or more, you don't have to pay sales tax on it. What you need to do, though, is really prior to purchasing that, you've got to have a certificate provided to the seller that says it's exempt from sales tax. Now, I have sent Jane a sample sales tax certificate, and she's going to have it posted on the VMA's website. So you can visit that. You can visit. As you can tell, we're really trying to drive people to see the amount of resources that we have on the VMA website. And so we will put that certificate up there, and so you'll be able to use it. I just want to make sure that everybody is aware that this became part of law this year. It's permanent. If you're buying equipment, you need to try to take advantage of the sales tax exemption. Similarly, and this has been around for a long time as well, sales tax on electricity. And actually, before we do this, I think I have a polling question. Polling question number 3. Are you getting a sales tax exemption on electricity using your manufacturing operations now? So I'll give you a few seconds to. Okay, we're almost 50-50 there. So for those that are not, there is an opportunity for you to have an exemption on your sales tax and electricity used as part of the manufacturing component of your building. Okay, so I know that FPL, for example, has on their website all sorts of information on how to do it and how to qualify for it. This is just another one of those areas that I want to make you aware of, so that way you can take advantage of this opportunity that's out there. From what I understand, in some cases you may have to have a separate electric meter measuring that. But I think if you visit FPL, wherever your electric company is, they have information on their website that allow you to take advantage of this. All right. With that, we're going to move. We've got a few questions up there that I'll go through. So a couple of questions that we had. What's the risk of being audited by taking the R&D credit? Well, what they'll do is they'll basically, if you go through what's the risk, how high is the risk, might be a question that I get all the time. That's hard to say. I'll tell you that if your R&D credit is a massive credit that all of a sudden starts popping up, it'll probably highlight to the IRS, and there's some potential risk there. The IRS, obviously, as you guys know, are fairly overwhelmed in their duties, and so these days I haven't seen as many IRS audits, but that doesn't mean. But they do look for red flags. So a huge, unusual type of R&D credit, for example, as compared to maybe the size of your business, might stick out as a red flag. Now, keeping in mind, one of the things that I didn't mention with the R&D credit, if you're part of the 13% or 12% that is not taking advantage of the R&D credit, or if you were part of that 88% that is, and you don't feel that maybe you've been taking in full advantage of it, you can go back 3 years and amend your tax returns, and you can take advantage of those R&D credits going back 3 years. But obviously, some people fear the idea of amending, and that does open up your tax returns for another 3 years from the IRS potentially being audited. In terms of the risk, I go from the standpoint: if you're doing what you're supposed to be doing, you properly document it, I don't really worry about the risk. Now, I have seen companies that took the R&D credit that should not that took more than they had to, and essentially the IRS worked with. It was a kind of an expensive endeavor because they had one of those firms that got too aggressive on things, and so when we worked it down, we got to a good number. Essentially, they took away the R&D credit and any benefit that went along with it. Up to the portion, they did get some of it. It's just not all the stuff. They just shouldn't have been claiming that particular part. So that's always your risk in anything. But I always go from the standpoint: if you document things very well, it's for a permitted purpose, you're going to be fine in R&D if there's any sort of audit. How large does a project have to be to make it worthwhile to pursue the R&D credit? Well, like I said, it's a 6% net, probably approximately a 6% net number. So, that's kind of a judgment on your side of things. If it's not worth $1,000 of a tax credit, for example, to track all of this stuff, then don't track it. So at least you have kind of a number in your mind. If you get up to $100,000, like I said, you're looking at possibly a $6,000 credit, and the documentation really is probably not all that overbearing. I mean, really, it's probably stuff you already are doing anyway. You're going through testing processes. You're going through it's probably just a little bit of extra tracking of costs more than anything else. So I personally would take advantage of it from the standpoint of I like having every dollar I can, and I know a lot of you out there don't like. I know a lot of you don't like paying Uncle Sam more than you have to. So. One other question: how does an employee become certified so you can take advantage of the? Well, like I said before, you're going to have them fill out those 2 forms. When you have them fill out those forms, and you can easily download. I gave you the form numbers. You can download those forms from online. You're going to submit them online to the state, and then you'll get a certification back. I think it's a 9063. You'll get that back from them, and you'll be able to claim the credit on your tax return. I think that about goes through everything that we have. Like I said before, if you have any questions, if you have anything you want to, you can always email me. We're going to put this stuff up on the BMA website. We're going to hopefully get some feedback from. You're going to have an opportunity to give feedback for us on this, particularly the format, what kind of format that you want, and what topics you want us to cover. So that way, the BMA, we can go out and get the right speakers to talk through these topics for you. Jane, anything else that you want to add at the end?
No, great job, Mike. And everybody go out there and save some money.
Thanks, everybody. Have a great day.